Egg yolk, what is going on with the viewers across the tube? I'm sure you know by now, but if not, my name is Tyler, and welcome to the channel that is more vocal than this little pooch stuck in a drive-through line.
Lines work, Walter. You can't just go to the front because you're Walter Jeffrey. That's not what it is. You know, you're not even popular here in Austin, Texas, to be honest.
You know our hound dog howl. It's time for Chico Crypto. If you didn't know, the real fun began yesterday, my friends. Miners in the Bitcoin industry started to realize their profits were being slashed in half. The reward is now officially 6.25 BTC per block, or just 900 new Bitcoins per day, or at current prices, over $79 million per day. Although over the weekend, it was 12.5 BTC per block, or 1,800 new Bitcoins per day, or at current prices, over $158 million. So some miners out there are definitely feeling the pain, but when you check out the hash rate chart over the past 7 days, it's not a terrible miner purge yet, as the hash rate dipped from 136 million terahashes to 125 million terahashes, a purge of just 8%. And with the hash rate staying where it is, with the network difficulty where it is, the prices have to stay here or above for a significant majority of the miners to stay profitable. A ton of operations in the US, Europe, and Australia are actually losing money at these current prices. But even with the dips into the 7K and high 6K range, operations in Eastern Europe, Russia, and China even become unprofitable, but only if the hash rate and difficulty are around the same level. And this can be seen with pre-halving break-even data with miners and certain electricity costs. If you were paying 1 cent per kilowatt hour, you were extremely profitable pre-halving, even when 25% goes to other costs like cooling, as break-even was still under $1,500. But not too many places pay that cheap, even in China. Now up to the 7% kilowatt hour is where miners would break even or begin to lose money based on additional costs. But now with the halving, you have to realize that the costs have doubled for the BTC miners, and those break-evens have all been multiplied by 2, which means prices for these operations have to increase, or the miners will be subjected to Bitcoin prices below their break-evens, which means they are then forced to sell not only all of the coins they mine on an ongoing basis, but they may also be forced to tap into their balance sheet reserves, causing additional selling pressure on top of their persistent ongoing sales. And you know what? That mining data I showed was taken by Coinshares, an investment and research company, and their chief strategy officer, Melton Demirs, who is a total babe by the way, said this when referencing the firm's observations of the mining industry. I think miners are looking to opportunistically offload some of their Bitcoin inventory to add operating capital to their balance sheet. We've been talking to a number of miners on Coinshares capital broker-dealer side who are looking at raising capital to build out new facilities, to buy new machines, and to extend their capacity. Raise capital, that means selling more BTC than usual, unless the price goes up. What could make the price go up for the short to medium term? Well, the Federal Reserve said in a press release, New York Fed announces start of certain secondary market corporate credit facility purchases on May 12th. Yup, yesterday, some crazy brand new thing the Fed and the Treasury Department conjured called the Secondary Market Corporate Credit Facility, SMCCF, went live. Of course, it was established because of the virus, but according to the Fed's own documentation on what it does, the SMCCF may purchase in the secondary market corporate bonds issued by investment-grade U.S. companies, or certain U.S. companies that were investment-grade as of March 22nd, 2020. So the key here is they need to be investment-grade corporate bonds or ETFs, which means a rating of BBB- or above. No junk bonds, but there is a loophole, or certain companies that were investment grade as of March 22nd, 2020. So they can currently buy junk bonds as long as they were investment grade before the viral panic. Now, Bloomberg also covered the launch of this facility, and they covered a certain ETF in their article. The 44.6 billion iShares iBoxx investment grade corporate bond ETF rallied 0.8% after the market opened on Tuesday. The 21.3 billion iShares iBoxx high yield, aka junk corporate bond ETF climbed 0.5%. Who is behind the iBoxx corporate ETFs? Blackrock Financial is. And guess who is a key player in the response to this pandemic? Blackrock Financial is. Bloomberg covered it last month. BlackRock becomes key player in crisis response for Trump and the Fed. And in the article, BlackRock has a premier role in helping Federal Reserve stabilize markets. The central bank has hired the firm to help manage its economic relief efforts, which the Fed admits from another press release of theirs about the SMCCF. On March 24th, 2020, the New York Fed retained BlackRock Financial Markets Advisory as a third-party vendor to serve as the investment manager for this facility. Then Steve Mnuchin and Snoogan
Snoogans
let the world know too, and that they wouldn't be making money off of them. Let's listen in.
Well, any of the people who are working with us have already agreed to work at very, very, very reduced rates, making sure that, this is a special situation. So we're not going to be paying big fees to any of these people, and we're going to make sure there aren't conflicts in any of the people we hire. And as I said, there'll be full transparency. So the president is right. He's asked me to make sure. I'm sorry, go ahead.
So do you have names for any of those individuals who will be doing this?
The Federal Reserve has already announced that they've hired BlackRock. BlackRock is one of the largest asset managers in the world. BlackRock was involved in the financial crisis last time. Larry Fink has enormous experience. So that's one of them that has been disclosed, and as we hire more people, we will fully disclose it.
Okay, Snooch my nooch, then what is this from a detailed document about the facility? A fee structure for the SMCCF is based on the value of corporate bonds and loans acquired and held by the facility. BlackRock will charge 1, an asset management fee, and 2, program administration fees for setup and operation of the facility. So Stevie boy, don't BS a BSer. We know BlackRock is going to make bank off of this and become even more powerful. You said it yourself. They helped in the 2008 financial crisis with CEO Larry Fink at the helm. It was called BlackRock's decade when Bloomberg in 2018 said how the crash forged a $6.3 trillion giant. Yep, from this chart we can see they managed just over $1 trillion in 2008. By 2017 was over $6 trillion. I wonder how much they managed in 2004. Well, from a corporate media release, assets under management of $321 billion. Wow, now that is some real growth from $321 billion to today over $7 trillion in just 16 years. Now, if we want some perspective, what BlackRock manages is 29% of the national debt of the United States of America. The debt clock shows just over $25.1 trillion. But tick-tock, tick-tock, it's growing by the second. Although who brought BlackRock on in 2008 to help with the financial crisis? Well, it was the George W. Bush presidency, as it was May 2008 when they got the call to fix Wall Street. But Obama took over in November of that year. And how many times did the Obama White House and BlackRock execs meet? Well, according to BlackRock Transparency Project's website, there was 98 meetings between Obama White House officials and BlackRock executives, 185 meetings and phone calls between senior BlackRock executives and Treasury secretaries spanning the Bush and Obama administrations. And finally, Obama and Larry Fink, CEO, personally met 16 times. But what is weird, there is not a single picture of the two together to be found online. But we are doing it all over again with the Trump administration now. Like, for those who are still blindfolded and don't see each administration from the Bushes to the Obamas to now the Trumps all have the same damn goal and work with the same damn people, I feel sorry for you. Trump and Fink are best friends. They like to play schoolboy push and shove. And now this facility has put us on a dark timeline. It was in 2008 dark, it was just hidden better because of Obama's squeaky clean image. But now we have shifted to where the dark is clear as day. By giving BlackRock full control of this debt buyout program, the Fed is further entwining the roles of government and private actors, and in doing so, it makes BlackRock even more systematically important to the financial system. Yet BlackRock is not subject to the regulatory scrutiny of even smaller financial institutions. All doom and gloom, I know, and I said there could possibly be demand from Bitcoin from all of this, remember? Well, back in July of last year, Larry Fink said this: the firm is evaluating cryptocurrencies. And the article states, Chief Executive Larry Fink on Monday said the world's largest asset manager has assembled a working group to look at blockchain technology and cryptocurrencies such as Bitcoin, but cautioned he does not see massive investor demand. No demand. Then why just a few months later, in October, the head of your working group said this on a podcast?
So we talked about how there was a lot of enthusiasm about crypto in 2008 with the initiation of the first birth of Bitcoin, if you will. A lot of excitement in 2015, 2016, and then now people kind of roll their eyes. It feels like blockchain is a tired buzzword. So where do you think we are in the hype cycle, and where do you think it's going?
Even though blockchain and crypto are, fundamentally distinct concepts that may ultimately have different endings, blockchain hype cycles very much tracked Bitcoin's cycles, and we've had 3 of those in its 10-year history. The first being from inception basically through 2011, and the second peaking in late 2013, troughing in 2015, and then of course the third peaked in sort of December of 17. And so for the last year and a half, that's where this trough of disillusionment has really set in, where people have started to tire of the buzz and question whether this was going to be anything. But just as is typical in sort of that classic Gartner hype cycle, as that is happening on the ground, fundamentals are actually improving. So speed, privacy, security, scalability, and real development is happening.
And then, going back, 2018, the head of your working group, Robbie, he has been putting out work regarding Bitcoin and crypto. He co-authored this research paper in June of 2018, a fundamental valuation framework of crypto assets. As we can see from the bios, the authors are both connected to the Ripple. Susan serves on the board of directors, and Robbie, he worked for them in the summer of 2017. And what I find funny from the report is even though they are rip heads, they give Bitcoin a better chance of succeeding. As we can see from section 3.1, model application, estimating fundamental value for BTC and XRP. They assign Bitcoin a success rate of 30% and a failure rate of 70%. And with XRP, we can see they assign success at 25% while failure is 75%. They think BTC has a better chance. And what I love is their conclusion. We have demonstrated the practical application of the model on 2 leading crypto assets, BTC and XRP, and arrived at a fundamental value range today for BTC of $13,600, $28,100, and for XRP of $1.59 and $8.23. This result, through calculated using imperfectively precise estimates, suggests that both BTC and XRP may have significant upside from the current price levels, despite the spectacular price appreciation in both currencies since early 2017. So some Ripple heads will say, hey Robbie worked for Ripple for a summer, it means BlackRock and the Fed are now going to be using them. No, as you can see, since they made that evaluation call in June of 2018, the tokens were at 45 cents. They are now at 19, a 1-year loss of nearly 60%. Bitcoin, it's basically where it was, actually a tad bit higher, as it was below 8K in the beginning of June 2018. Bitcoin has increased by 10%. You would think Robbie, an investor at heart, notices things like that. And here's a little piece of information we need to come and put together. So we found out in March Brian Brooks, who was Coinbase's chief legal officer, was joining the Treasury department and reuniting with his old One West friend Mnuchin. Guess who has been advising Coinbase for the past 18 months? Blackrock. And they began exploring a crypto ETF together back in June of 2018. which suspiciously came 1 month after Coinbase was the first fintech company to speak with US regulators, the Treasury Department, about acquiring a federal banking license, which was unfortunately stopped by New York. We covered this 2 weeks ago in the video proof that the dollar is going digital, which the Treasury Department, specifically Brian Brooks' helm, the Office of the Comptroller, appealed. And we are still waiting on that decision. But in the meantime, they want to get things rolling for Bitcoin and crypto. Why do you think yesterday JP Morgan announced they are now providing their banking services to Gemini and Coinbase? So if you take the time to find and connect the pieces, they go right together like IKEA furniture. No solid directions, but once it's put together, you realize this is some good shiznit. Cheers, I'll see you next time.